It's not just for death benefit. In this episode, I'm going to address the question, why do wealthy people buy so much life insurance? Well, maybe they know something that you don't know, but you can't be aware of something you're not aware of. So in this episode, I'm going to blow you away and enlighten you with the concepts of why the wealthy people buy more and more life insurance the older they get. So my name's Doug Andrew, and I've been helping people optimize their financial assets now for more than 48 years. In doing so, many times people would come to me as a retirement planning specialist, and they want to know where the best place to put their money, their serious cash, to be able to not only accumulate at the best internal rate of return, taking into consideration taxes, inflation, market volatility, and so forth, but also to be able to generate income that they would not outlive in retirement. The savvy ones would understand that the three biggest dangers that would cause most retirees to outlive their money were taxes, inflation, and market volatility. So I would make them immune from those three dangers. I would eliminate them from their portfolios. And it's amazing how many financial advisors still do not know how to do this. Unfortunately, a lot of financial planners try to charge up a retirement battery, so to speak, that hopefully won't go dead before you do. The problem is there are three big things that short out that retirement battery, the IRAs and 401ks and money in the market and so forth. It's taxes, inflation, and market volatility. So what I have loved doing is giving people very powerful generators, so to speak, that will generate tax-free income into perpetuity that is totally immune from taxes, inflation, and market volatility. And the instrument that accomplishes this the best is a max-funded indexed universal life insurance contract that's structured correctly and funded properly. And if it is, it qualifies to be called what I named a laser fund, which is actually the title of one of my best-selling books that I want to gift you free at the end of this episode, so stay with me here. People will usually come up at my events and they'll go, Doug, you showed some examples on the screen in the last session, because I teach sometimes 2 and 3 day events. And you showed examples of Walt Disney and J.C. Penney and Ray Kroc, who started McDonald's. David Walker, the comptroller that was under the Bush administration up until the Obama administration, when he resigned because he got frustrated. He couldn't tell the public the truth of how close we were to a total financial collapse in 2008. And they are all big proponents of owning a ton of permanent life insurance. And people go, why did they need life insurance? They had the money. Well, actually, there was a point in all of their careers where they didn't have the money, and money inside of their insurance contracts was their saving grace. In other words, J.C. Penney bailed out J.C. Penney and kept it alive when it was in trouble financially by accessing money the smart way, borrowing it out of his insurance contracts. Do you know that Ray Kroc did the same thing to keep McDonald's alive? We wouldn't have McDonald's today if it wasn't for his life insurance policies that gave him liquid access to cash, tax-free. Same thing with Walt Disney. Now, the neat thing about Disney is he actually went broke about 7 times and had a nervous breakdown before he finally made it. And what's so ironic about Disney is he actually came up with an idea that he shared with his brother. I won't tell you his name. And he said, hey, I've got this idea. I've always been afraid of mice. And I want to make a cartoon that depicts a mouse that is friendly. And his brother said, Walt, that idea will never fly. Yeah, well, it was Steamboat Willie, which turned into Mickey Mouse. Mickey Mouse has been the #1 entertainer in America for over 70 years. And his brother, Roy, a lot of people don't even know Roy, but we know Walt because of Mickey Mouse, a recession-proof mouse. Walt Disney, when he was ready to throw in the towel, he was out of all resources. He used his life insurance policy to save and come up with the idea of Disneyland and everything that we enjoy today, with Disney and all of his creativity. Same thing with David Walker in 2008 when the market dropped 40% for the second time in a decade. He went around the country after he resigned from being the Comptroller General, the General Accountability Office, and he told people the safest place, the wisest place to have serious cash to protect yourself from market volatility is in max-funded, indexed universal life insurance contracts. Now, what do they know that maybe you don't know? That insurance is really there more for living benefits than just the death benefit. A lot of people think insurance is just there to protect you in the event of a premature or untimely death, so that if you die and you don't stay around like you had hoped to for your children, grandchildren, your spouse, that they'll have the wherewithal to be able to continue on in life with dignity and so forth. Yes, I've had a lot of clients who have passed away, and this was a blessing to those they left behind. But most of my clients never came to me wanting or even needing life insurance for the death benefit. They had the money. See, a lot of buy term invest the difference proponents say, oh, you buy term invest the difference and after 30 years you'll have the money, now you can let go of the term insurance. Well, then why are so many wealthy people buying so much life insurance when they're in their 60s, 70s, and 80s? I'll share the answer next. Before I share this with you, if this is intriguing you and you can think of somebody who ought to watch this episode, be sure and share, post a comment, click like. But I want you to subscribe to this channel, Three Dimensional Wealth. It's free. If you click the bell, you'll be notified every time I post a new video. These are educational videos designed to enlighten you and show you opportunities that maybe you didn't know existed before. And I post one almost on a daily basis. And I usually then will provide an opportunity to get a copy of a book that will help you understand the concepts that I teach in the videos. And that's what I'm going to do at the end of this episode. I want to gift you a free copy of my most recent 300-page best-selling book, The Laser Fund. Okay? So please subscribe and share. These savvy people, they are using life insurance for the living benefits. This was actually the brainchild of E.F. Hutton. They were a brokerage firm back in 1980. They weren't an insurance company. They realized that the multi-trillion-dollar insurance industry is not only the backbone of America, but the backbone of the world. This is where governments go to for help. Do you know that just one insurance company where I have some of my money manages as much money as the IRS collects in taxes in an entire year? About $3.5 trillion? One company. So they are money managers. And this is where many banks and credit unions will take money that you deposit into them, and they pay you a measly 1%, and they turn around and put 30 to 40% of their tier one assets into these insurance companies and earn 5. How much more is 5 than 1? Don't say 4. It's 5 times. Every million they borrow from us, when we put money in a bank, it's in a lended position, they pay $10,000 in interest. And they turn around and make $50,000. $50,000 is 500% more than $10,000. They do this to increase the safety and the liquidity and the rate of return by 5 times. You can bypass the middleman. So the answer to why do wealthy people put their money in insurance or buy insurance when they're in their 50s, 60s, 70s, and 80s? Yeah. It's because they understand where else can they accumulate their money tax-free. This has been grandfathered in the Internal Revenue Code for over a century. Section 72E allows your money to accumulate tax-free inside the insurance policies. You're taking the least amount of insurance the IRS will let you get away with and put it in the most money the IRS allows it turns into this tax-free cash cow. But what if you need to access money? If you put in $1 million or 10 million, we have people putting in 10 million a year. We had a woman years ago who put in 200,000. She said, I'll never touch this for 20 years. 2 months later, she was in this horrible accident. She called me and said, Doug, I need 120,000 of that 200,000. She called back 2 days later and I said, Beverly, I had it overnighted. Have you checked your mail? She went out, oh, it's here. Yeah, it's liquid. You can access the money. You want the liquidity. But she didn't have to pay tax on that. She could access it. There's no 10% penalty. They want the liquidity. Number 2, they want the safety of their money. The last domino that would fall if we had a total financial collapse in this country. That's why David Walker said, this is where I have my serious cash. It's the last industry, the insurance industry, that would fall. The banks would be failing first. You'd have lots of warning to get your money out. But frankly, if it was that bad, the American dollar would probably be worthless. So you better be able to grow carrots in your backyard if that happens. But the point is this. You want to have money that's liquid and safe and then earning predictable rates of return. They know they don't need pie in the sky rates of return. Some years they're gonna earn 25% and even 60%, like many did this year. They're recording this video in 2021. But on the average, if you earn 10% tax-free, your money doubles every 7.2 years. So that's why Disney and J.C. Penney and Ray Kroc and David Walker and many savvy people will buy the insurance for the living benefits. But let me just simplify it. If I reposition $1 million and I put it over into a portfolio of laser funds, max funded index universal life insurance contracts, if I need to access that million, I can, anytime I need to. It's growing tax-free. It's very liquid. It's safe. It earns predictable rates of return. It'll double to 2 million and then 4 million and 8 million every probably 7.5 years based on actual history. Why would I earn this rate of return in a volatile stock market when I can earn double that or triple that? Why would I generate on every $1 million $40,000 of income when I could generate $80,000 to $100,000? Why would I generate this when I could generate this? And at the end of the day, when you pass away, why would you leave behind this cash in a mutual fund or an IRA or 401k when you could leave behind this, double or triple that, tax-free? Why would you generate this when you generate this the rest of your life? And why, when you finally die, would you leave behind this when you can leave behind this, if it doesn't cost you anything? Most people go, well, nothing's free. No, but I don't pay for it. It's being paid for with a minuscule portion of money that would otherwise go out the window in unnecessary tax if I followed the herd and put my money in the market in traditional IRAs and 401ks. If you're intrigued, let me show you how you can learn more. I would strongly recommend you claim your free copy of this 300-page book. It's called The Laser Fund, How to Diversify and Create the Foundation for a Tax-Free Retirement. It's actually 2 books in one. This one, the white covered side, is about 200 pages with all the charts and graphs and explanations, 14 chapters. If you learn more by stories and examples, you flip it over, you read this one, 100 pages, 12 chapters with 62 chicken soup for the financial soul stories. If you want to use both the right brain and left brain, read both, okay? But folks, simply go to laserfund.com, L-A-S-E-R fund.com, click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. I'll pay for the book, fire it out to you. There's options there to listen and learn and watch and learn. But once you begin to understand this, you'll want to reposition your money where savvy, wealthy people put their money for liquidity, safety, predictable rates of return, and totally tax-free.